Hello and good morning, everyone. Welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The health of the labor market is something Fed tracks closely. As per the US JOLT survey, the job vacancies fell to 9.9 million in February, down from 10.5 million in January. The ratio of open jobs to unemployed people, which is tracked closely by the Fed, fell to 1.7 from 1.9. Now, these are some signs that the Fed will be monitoring, but there still exists divergence between what the market is expecting in terms of rate cuts this year versus the Fed narrative and dot plot, which indicates rates to remain above 5% in 2023. On the rates front, two neighboring countries adopted two different philosophies. Reserve Bank of New Zealand raising more than market expectations, coming across hawkish, while the Reserve Bank of Australia opted for not hiking and adopting a pausing while not ruling out further hikes. JK, a lot of developments. Want to hear from you how you're reading these data points, and has the divergence started to widen again between what Fed thinks and what the market is pricing?
Hey, good morning. Yes, first on the US economy, there are more and more evidences that the economy is cooling. On Monday, we had the ISM manufacturing report that actually fell from 47.7 to 46.3. And more importantly, employment index plunged and the prices paid were also below 50. Then came yesterday's job openings data, as you gave the details. But apart from the heartening point, you can also see that the rate at which people quit the job also increased. So that is also a sign that it's not totally loosening the labor market. It's still tight. And further, we would like to see the ADP jobs report today and more hard data like the ISM services, which makes a large part of the US economy. And this would be more better clues to watch on the labor market. Of course, finally, we have the reading on the non-farm payroll on Friday, where again, expectation is for about 240,000 increase in unemployment rate unchanged. So, yes, there are good signs, but I think it's too early to say that it's cooling off. Yeah, but on the other hand, we also had factory orders dropping more than expected at minus 0.7 versus minus 0.6, and it was another month of fall because last month also it fell by 2.1%. So it may be too early to conclude, but definitely if the inflation is not cooling off and at the same time economy is slowing down, then fears of stagflation arises, and that probably was the reason why yesterday, despite the fall in yields, stocks were also down. And so obviously market is looking to see whether the rate hikes by Fed for the last 1 year is resulting in a sharp slowdown in the economy. That will determine how the risk assets perform. Of course, as far as the market is concerned, these are second-tier data. They would like to see hard data like CPI, employment, and retail sales, which should be forthcoming in the coming days. On the central bank front, yes, RBA was mostly expected to pass, but they did not, rule out a further rate hike. They also noted that the economy was slowing, particularly the housing market was, cooling off, and employment also was down. So I think their decision was purely based on domestic economy. And New Zealand, of course, surprised us by hiking by 0.5% versus 0.25 expected. Now, again, the heartening point of all this is that people are taking, rather the central banks are taking decisions based on the domestic economy and not influenced by the recent banking-related crisis. In fact, there was more hawkish statements from ECB members yesterday, and the wage price spiral actually is calling for more stronger monetary policy response. That was one of the members. Then there was a hawkish bill from Bank of England, who said MPC's communication about outlook for monetary policy, though has shifted, it still onus remain to ensure enough monetary policy tightening is delivered to see the jobs through. So they're hinting at more hikes. But surprisingly, another member of MPC hinted that a 10-year-old, I'm unable to slim properly, but I think he's an outgoing member, a slightly dovish member, but he actually called for loosening the interest rate cycle, but not much importance was given to his statement by the market. And we had dollar falling again yesterday. Euro, GBP, and then these are on in limelight. And yen, of course, surprise. Not quietly, the yield on the yen 10-year JGBs have shot back to near the ceiling of Bank of Japan from about 0.17 that was seen in the wake of banking crisis. So along with that, US yields have fallen. So dollar yen has quickly fallen from 133 plus to 131.5. And technically looking more losses, but again, we'll wait and see if Bank of Japan steps in with any fresh JGB purchases to control the yield. And if we do see a close about 0.5% on the yields, then there can be some more selling in the dollar yen. We are hearing that there are very large offers from Japanese exporters to hedge their yen receivables. As I said, the 2-year declined, and it was down by 12 basis points to 3.84, and 10-year by about 7 bps to 3.3. And rate futures are now more tilted towards a pause in May. It's like it's swinging, just like in the currency swings, it's also swinging from one day to hike, another day to a pause. And these are definitely very volatile atmosphere, and we have more data coming up, ADP and non-farm payrolls, services, PMI also. All these things will be important. We had a euro hitting 2-month high yesterday, GBP hitting 10-month high. Swiss franc climbed to highest level since August 2021. Of course, yen is the one to watch out for me because of the factors that yields in Japan are slowly rising and yields in US are coming down. I think for once the bad news was taken as bad news by stock markets. So the weak data across made some dent on the stock prices, but it can also be put down to some profit taking, because we have had a good rally in the stocks from the bottom seen after the banking crisis. S&P 500 has gained about 7% in 2023, although overall it is down 15% from its record high also. So now, importantly, there are some geopolitical issues emerging. On Monday, we had heard about Japan actually, imposing export controls on 6 categories of equipment which are used in chip manufacturing. And that is actually, impacting some of the big industries in China. And China has come out today with very strong statements opposing such measures from Japan. And, I think this is not a good development, because Japan and China are very big. They have very big mutual trade, and I think Japanese Commerce Ministry is hinting at taking decisive measures to safeguard its rights and interests if Japan insists on obstructing this chip industry. And in another geopolitical development, Finland became officially the 31st member of North Atlantic Treaty Organization, marking a major shift in the security landscape in the northeastern Europe that adds some 1,300 kilometers to, its a frontier with Russia. Now, this is not to the liking of Russia. Russian foreign minister already said that NATO's expansion, of its full scale, NATO's expansion is not something that they should be doing, and it actually is creating more tensions in the region. So we have to watch out if there is any response from Russia, because this was one of the important factors on which Russia had taken its unsavory attack on Ukraine. Finally, the people are also watching how the credit conditions in US is happening. I think there are some early signs that credit conditions are tightening. There will be more data on this, which will be watched in the coming days, important for how the economy will perform in the coming days. On to India. Again, mostly Indian rupee has been underperforming this latest dollar index down move, and on Monday we had seen that good absorption of selling from the market by the PSU banks. And although we have hit below 80 to 10 in NDF market, it remains to be seen whether the nationalized banks are still active to curb rupee strength and keep it slightly higher. then and it's also down to whether we get more flows in the coming days. Finally, we have seen the World Bank and Asian Development Bank revised down the growth projection for India. World Bank from 6.6 to 6.3%, and that is actually hinting at lower consumption and unfavorable external environment. ADP cut from from 7.2 to 6.4, a big drop. And again, they are based on ongoing global economic slowdown, tight monetary conditions, and elevated oil prices. So all in all, Indian economy overall in the domestically doing very well. We had very big record in the GST collections and external factors. In fact, the Commerce Ministry is hinting at a new record in merchandise exports. Also in the, so we will see how it reflects in the coming trade data. Overall, macros are looking good for rupee, but actually whether the currency makes further headway depends entirely on the flows and RBI. Thank you.
Thank you, JK. And just to quickly summarize what you discussed, there has been some evidence that the economy in the US has been cooling, while all of this has raised fears of stagflation, which is a slowing economy along with sticky inflation at a higher levels. New Zealand's 50 basis hike was a surprise, and yesterday we also had ECB and BOE members being quite hawkish in their statements. What all of this led to was Euro and GBP strengthening against the dollar, cool off in US yields, while rate hike expectations are swinging with each data point between a hike and a pause. On the geopolitical front, some tensions between Japan and China regarding chip manufacturing, while Finland has become a member of NATO. That's it from us today. Thank you so much for listening. See you all tomorrow with another round of fresh updates.